the last YouTube video, we looked at lending from good to bad to downright illegal. Getting a loan is an important part of business, but can come with a serious danger since the money borrowed has to be paid back. In order to alleviate some of these dangers, while still getting money, some entrepreneurs will instead look to sell equity in their company. This is where private investing comes into play. I'm now going to tell you the different ways used for individuals to raise money without getting a loan. Convertible loan note. This is a loan that gives the lender the option to convert the debt into equity in the company that the loan was for. These loan notes, also called bonds, can be susceptible to interest changes and is usually initiated by the one who owns the bond. Seed capital. Seed capital is money that is raised by private investors in startups in exchange for either equity in the company or a share of future profits. Most of the money comes from friends, family, and those who personally know the entrepreneur. These funds are not as large as other options in this list. Crowdfunding. Crowdfunding is when you raise smaller amounts of money from more people than typical syndicators. Most individuals who want to crowdfund use social media or specific websites. Places like Kickstarter or Indiegogo are websites that people use to raise money for their personal projects. There are numerous restrictions and laws about crowdfunding to help cut back on potential scams. Angel investors. An angel lender is an individual that is very wealthy who is looking for a high rate of return on their money. These individuals specialize in providing financial support for startup businesses. Since these individuals know the business is new and does not have consistent cash flow coming in, they are usually given a part of the company as equity. It is not unheard of for an angel investor to be involved with multiple projects at once. Venture capitalists. A venture capitalist is an individual who provides funds to companies that have high growth potential in exchange for equity. They are usually limited partners in the deal. While this sounds like an angel investor, they usually are not funding completely new startups, but instead companies that have generated some form of profit and have potential to grow in the market. This potential can come from strong management, a large market or product that is unique or special. Corporate venture funds. Similar to venture capitalists, corporate venture funds are where businesses pool their resources and investor capital into a fund that then invests into startups. Syndication. Syndications are where investors pool their money together to allow the general partners to manage the funds, usually in the form of purchasing an asset, such as an apartment complex. Due to federal laws, only accredited investors are allowed to invest in syndications unless the individuals all personally know each other. An accredited investor is someone who makes $200,000 a year or has $1 million worth of assets not including their own home.